In this lesson, I'll be explaining how you can make money when prices rise and also how you can make money when prices fall. And these are going to be very important concepts to understand because it's going to help you take advantage of predictable price movements when other traders apply these tactics. So if you're ready, let's get into it. The first way to make money is buying low and selling high, which is called going long. When you go long, you are entering into a position by buying shares and then exiting that position by selling shares. So if you are anticipating the price to go up, then you would hit the buy button to enter and then hit the sell button to exit. So in order to make money going long, you would need the price to rise from where you bought it at and then sell at a higher price than what you paid. For example, if you bought shares at $5 and then the price rises to $7 and then you sold when it was at $7, you would have made a profit. However, you can lose money when going long, and this happens when you buy high and then sell low. If you bought at $5 thinking the price goes up, but it doesn't, and it ends up going down to $3, and then you sold at $3, you would have lost money. Now, going long is the traditional and most common way people make or lose money in the stock market. But there's a second way that people make or lose money trading, and that is shorting. Shorting is where a trader enters into a position by borrowing shares from their broker to sell, and then they exit that position by buying back the shares and returning them to their broker. This is the exact opposite of going long, and you would do this by hitting the sell button to enter into a position and then hit the buy button to exit out of that position. Now, side note here, when it comes to shorting, you'll often hear the term short and cover. This just simply refers to the selling and buying actions for a short position. So if you ever hear someone say they are short XYZ stock, it just simply means that they have entered into a short position by placing a sell order. If you ever hear someone say they are covering XYZ stock, it means they are exiting out of their short position by placing a buy order. So if you wanted to make money going short, you would need the price to fall from where you entered the short position and then exit at a lower price. So if you entered a position by selling at $6 and then the price drops to $4 and you exited the position by buying at $4, then you would have made money. However, if you shorted at $4 thinking the price is going to go down, but it doesn't, instead the price rises to $6 and you exited at $6, then you would have lost money. Okay. Now, shorting can be a confusing concept for people, which is why most traders trade to the long side. In fact, the market is more geared towards trading long, and it's what this course mainly focuses on. But even if you never plan to short, it is critical that you understand both sides of the coin, because understanding when and why people might play long and short strategies can provide you insights into future price movement. As an active trader, your job is to be able to anticipate whether the stock price might go up or it might go down in the future. And since prices are influenced by the collective actions of both long and short traders, you have to be able to understand how these actions might affect the market. So this is where we use charts to look at things like candlesticks, trends, or patterns to be able to help us recognize how people might be playing a particular stock and then take advantage of how that might affect future price movement going forward so that we can predict future price movement more accurately. I'll be explaining more of this in greater detail all throughout the course, but for now, I just wanted to introduce to you what long and short strategies are and how you can make or lose money from them. I hope you all learned something, and I'd like to thank you so much for watching.